So thankfully, the prior presentation was a great introduction to where I'd like to pick up here as well. The topic today is on corporate climate governance, and this is a paper that will be forthcoming. I apologize, it's not available to all of you today, but hopefully it will be posted online very soon. And it features some of the many developments that Rosa and Dan's paper has already highlighted, which is that over the past 2 to 3 years in particular, a number of key international climate and sustainability disclosure mandates have come online, and other new corporate disclosure regimes, as we've just learned about, including the CSDDD, have come online as well. In addition, last year, the OECD completed its most recent revision of the corporate governance principles, which I think is kind of supporting and considering very much these ongoing developments in thinking about the intersections of kind of stakeholder concerns, climate, corporate governance, and the like. And certainly in this region, Singapore, Hong Kong, and other Asian capital markets are already moving to align with these disclosure requirements, particularly the ISSB. I know here in Singapore, just I think a day or so ago, the consultation of the stock exchange closed on the ISSB alignment. So, and maybe some of you have contributed to that. So these are all very interesting developments. And I will point out something that Rosa mentioned and Dan mentioned a moment ago, which is that all of these measures, interestingly enough, build on and presume corporate governance. Good corporate governance mechanisms are in place, and indeed they leverage them. But none of these measures are primarily intended to change corporate governance. I think that's probably obvious. They're intended to kind of build on the status quo in terms of financial materiality, in terms of good corporate governance institutions, and indeed to harness them to promote better information transparency for investors and better risk management for companies. And again, maybe it's stating the obvious, but these measures are not embedded in company law. Okay, these are not sourced in domestic corporate law of any particular jurisdiction, nor do they purport to speak to all of the issues company law speaks to, such as corporate formation, fundamental transactions, and the like, or corporate decision-making power. Indeed, they bear their source in something from Rosa's last slide, which is what we might call international corporate law or transnational corporate law that scholars like Mariana Parvinder and others have explored. So the question that I want to look at today is, I think I've done something. Yes. What is the impact of climate and sustainability disclosure regulation on how we define and how we measure kind of good corporate governance? Bearing in mind that the definition of good corporate governance obviously will vary by jurisdiction as well. And just to look at the OECD's definition from 2023, I know many of your corporate governance experts in the room, but just in case, corporate governance involves a set of relationships between a company's management, board, shareholders, and stakeholders. And corporate governance also provides the structure through which the company is directed and its objectives or purpose are set. I think that's really important. We've spoken to that already today. It also speaks to the means of attaining those objectives and, importantly, monitoring performance. And so those are kind of the key elements that we think about when we think about corporate governance. So good corporate governance is notoriously difficult to measure. And if we look at studies and empirical work in the past on good corporate governance, we see that kind of traditional good corporate governance tends to focus on a divide between kind of internal characteristics or internal mechanisms and external governance mechanisms that you can see here on the slide that are associated with good corporate governance. And these have evolved over time, particularly as crisis happens, right? We get kind of new innovations in corporate governance to fix the problems of the last crisis, maybe not to fix the problems of the next one. But anyway, you can see a lot of the things that are kind of associated with good corporate governance. And some of these are associated with good corporate governance because we can measure them. Things like board size, diversity, independence, whereas kind of getting at what makes a really functional board function a little bit more difficult to measure. Okay. But then we also have external governance mechanisms, of which transparency and disclosure are one. Okay, so these transnational corporate climate and sustainability mechanisms kind of fit within that established paradigm in some sense, as again, kind of external pressure, investor-led pressure on governance. But if we look at how studies have measured good governance, there's some kind of key ingredients. Okay, and many of these ingredients are in kind of the green at the bottom here. We really tend to focus on low agency costs what contributes to lower agency costs between shareholders and management, strong shareholder rights, minority shareholder protections, and high financial performance. And indeed, if you look at good corporate governance indices and how we come up with those in the first place, we come up with them because we seek to identify measures of good corporate governance that are associated with different measures of profitability or value. Okay, so again, financial performance is our benchmark in determining what's good and what's not, and it is really kind of following from that tradition that we've just talked about. So there is also a substantial literature on good governance and sustainability, and all of the studies that are cited up here, and again, they're in abbreviated form. When the paper comes out later, you can reference the full citations, but these are all meta-studies or kind of literature reviews, which for the scholars in the room means these are not just single studies on these points. These are studies that intend to capture the findings of many, many studies over a long period of time in fields that are quite robust and where there's a lot of learning already out there about these relationships. And so when we look at what does the literature say about the relationship between good governance and sustainability, a couple of the findings are, first of all, that board capacity and expertise on sustainability contributes to board efficiency. Okay, so that's great. It's a win-win, right? Okay, we get the sustainability experts on the board, we're going to have even better boards. Number two, that there's a bidirectional relationship between internal good governance. Okay, so those, again, goes to things like board function, structure, and also sustainability, or some of the studies measure CSR effects, so corporate social responsibility. But it kind of goes the other way. Okay, so again, bidirectional, that companies that are good at sustainability may tend to have good corporate governance. Very hard to tease out what's driving what, okay? Number three, however, a lot of studies finding that board independence and diversity, again, those kind of internal characteristics of the board, promote sustainability or CSR. Okay. So our question is, if these international disclosure regimes are going to be bringing climate and sustainability kind of full front into even kind of financial related notions of materiality, and even if we're limiting our lens on climate to things that matter to the company's economic performance, we are integrating these concepts into corporate governance in a new way, and we need to engage now with kind of a substantial debate that's already been alluded to in corporate law over whether including climate, environmental interests, or the interests of other corporate stakeholders generally is good or indeed bad for corporate governance. So again, there's a literature showing that sustainability and good corporate governance have an association. Okay, but there's this massive ongoing debate that's been going on literally for 100 years, which highlights as well some drawbacks, particularly of stakeholder-oriented decision rules. So at the top, I have these kind of Easter eggs, which highlight a lot of the new slogans that have come out in the literature about how sustainability can be driving this kind of brave new world of corporate governance focused on stakeholders. So we have these concepts of enlightened shareholder value that I've written about in the past, new corporate governance, responsible capitalism, the ECGI has a theme on that, sustainable corporate governance, shareholder welfare, enlightened value maximization. So the list goes on and on and on about kind of the brave new world of corporate governance, right? But against it, there is a strong kind of literature about what if we actually asked corporate decision makers to base decisions in this manner? What is the standard against which they're going to be basing those decisions? And the problem is the classic two masters problem that was highlighted by Easterbrook and Fischel, and more recently by Babjek and Solarta and Miller and others, which is the concern that integrating climate and sustainability measures into corporate governance is going to bring higher agency cost to shareholders, but also to stakeholders. And it's going to shield management from scrutiny. It will be inefficient. It's going to involve trade-offs. There's no fair way to make these trade-offs. It's going to give management ambiguous marching orders, and it's going to be impracticable, and therefore value reducing. There's some sites here. The debate continues. Okay. But the TCFD, which is the framework that the ISB and all of these disclosure frameworks are based on, is governance-based. If you look at the 4 pillars here, the first 3 are core governance, okay? Director oversight, management, risk oversight, functions, strategy, and risk management. So again, these disclosure frameworks that are coming online are harnessing corporate governance, but they're requiring greater transparency, and they are affirmatively requiring corporate directors and managers to engage with and monitor sustainability and climate issues. In fact, definitions of corporate climate governance have been introduced within these frameworks. The top one is the TCFD, which is more of a financial single materiality measure, and the bottom one is a kind of double materiality measure from the EU. Okay. And Rose has already talked about it, so I'm going to jump ahead a little bit in the interest of time. But these different definitions point us to kind of two possible visions of what we might call corporate climate governance. One is kind of a thin version, focused on financial materiality and the elements of climate and sustainability that matter to financial value, profitability, and risk. The other is maybe a thick corporate climate governance conception, which requires more affirmative attention by corporations to reduce impacts and to really positively affect perhaps the environment. That's more the EU approach. Okay, but nonetheless, and so I've kind of got a slide here that kind of compares these. You can see, thin versus thick. Even with the thin conception, though, I would argue, we're looking kind of at a new world for corporate governance. This is not the way that we've been thinking of traditional good corporate governance in the past. We're expanding the lens of what we're expecting companies to do, and there's a lot on this slide. There's more about it in the paper when it's out. But let me just highlight a couple of the things in bold here. So on the left, you can see what we're looking at in terms of dimensions. Number one, how it affects corporate purpose. Number two, how it affects principal agent costs and how we think about that. Number three, how it affects the way we look at risk oversight and risk management, how it affects how we think about board strategy. And last, what about an affirmative obligation of corporations to do anything climate or sustainability related? So if you look across these, I've argued that climate and sustainability disclosure regimes, actually following them is incompatible potentially with shareholder wealth maximization as a corporate purpose goal. It is more compatible with everything else on the right, okay, which are kind of not unfamiliar to us, okay? But these imply resource-bounded constraints, more of an optimization purpose than a maximization purpose, and that's kind of new territory, frankly. Number two, this is kind of coming from the anatomy. Those of you who are familiar with the anatomy of corporate governance, we think in terms of kind of three major kind of agency conflicts. Corporate law has historically not dealt with a third one at all, the shareholder-stakeholder conflict. That one is front and center in these climate and sustainability disclosure regimes. We are bringing it back in. Okay, risk oversight. Historically, most of our jurisdictions, board discretion. Okay, it's up to the board to decide what risks to prioritize, what risks to ignore. That's not the world we're in today. You have to care about climate. Okay, and again, same thing with strategy. You have to be climate, sustainability, resilience focused. And then there's some literature out there suggesting that doing all this might in fact cost us something. Okay, so it might be profit sacrificing, and I leave that to the fiduciary duty panel in a little bit to get into. But I'm going to argue that this is a new world, okay? That even under a thin conception of corporate climate governance that's based on that kind of financial materiality standard, Singapore, Hong Kong, all of Asia is kind of following it, it's more revolutionary than we think. It requires stakeholder integrated decision-making and a climate-first corporate strategy. At the same time, thick corporate climate governance along the lines of the EU, I think is less revolutionary than we worry. I think it actually deals with the two masters problem because it's not unaccountable. It's very measurable. There's taxonomies, there are metrics, there's transparency. And so again, I argue that the thick double materiality corporate climate governance prioritizes specified risks, creates mechanisms for corporate accountability and managerial accountability and independent assurance. And I think it deals with this critical problem that we've been wrestling with for 100 years now. So I'm arguing that perhaps we're looking at a transformation of corporate governance. So I leave it to you to decide. Well, thank you.